Okay, let's dive in. Money market funds, MMFs. Maybe not the flashiest topic, but really, really crucial for how money moves around term, right?
Absolutely foundational. Think of them as, well, major parking lots for cash that needs to be safe and accessible, essential for companies, banks, governments.
Keeps the wheels greased, basically.
That's a good way to put it. They give investors, often big institutions, a place for their cash that earns a bit and is easy to get back. And, importantly, they provide vital short-term funding for others.
But, this quiet corner of finance isn't always so quiet. We've seen stress points.
We certainly have moments where vulnerabilities became very real.
Right. And today we're digging into what's being done about that. There's been a recent review looking at how different countries are strengthening these funds after those shaky periods.
Yeah, it's a stock take, really. Checking what specific rules and tools countries have actually put in place or are planning to, based on earlier global recommendations, to make MMFs more resilient.
So our mission here is to unpack the key findings. What are the real weaknesses? Why do they matter? What's actually being done? And, why should you care? What's the impact on the bigger financial picture?
Exactly. And potentially on your own financial situation, depending on how things play out.
Okay, so let's start super simple. What is an MMF? Really, just plain English.
Okay, fundamentally, it's an investment fund. But unlike, say, a stock fund aiming for growth, MMFs are all about keeping the principal stable and making sure investors can get their money back easily. Liquidity and safety are key.
And what do they invest in to achieve that?
Very safe, very short-term debt. Things like government treasury bills, high-quality commercial paper from companies, bank certificates of deposit, stuff that's generally considered low risk and matures quickly.
Right. And you said they're big.
Oh, enormous.
Okay.
Globally, we're talking US $9 trillion in assets at the end of 2022. That's a lot of cash.
9 trillion. Wow. Where is most of this concentrated?
Heavily in the US, then the EU, especially places like Ireland, France, Luxembourg, which are big fund centers, and also China has a very large MMF sector.
Okay, 9 trillion. But are they all the same, these MMFs?
No, definitely not. There's actually quite a bit of variety across countries, how they're defined legally, their structure, exactly what assets they can hold, who typically invests in them, the currency, the rules on how liquid they need to be. It differs. And a really critical difference, which is central to the whole vulnerability discussion, is the net asset value, or NAV. That's the price per share.
Right.
Many MMFs aim for a stable NAV, like a $1, €1, £1 per share, always. These stable NAV funds make up a huge chunk, like 82% of that global $9 trillion.
Okay, so most aim to look like cash.
Exactly. But here's the kicker. These stable NAV funds are actually only allowed in less than half of the countries looked at in this review.
Yeah.
Many places only permit variable NAVs, where the price fluctuates slightly with the market value of the assets.
Ah, okay. That difference sounds important.
It's crucial because it leads directly to the core vulnerability that authorities are worried about.
Which is?
The fundamental mismatch. It's between how quickly the fund promises you can get your money back, usually same-day cash.
Yeah, you expect that with a money fund.
Right. But the assets the fund holds, even safe ones, might not be instantly sellable for full value, especially if lots of people want their money at the exact same time during a market panic.
So promising instant cash but holding assets that might take a bit longer to sell without a loss? That sounds like a recipe for trouble.
It is. That's the classic setup for a potential run. If investors get nervous and everyone rushes for the exit at once, the fund might struggle to sell assets fast enough or at a good price. They might have to sell at a loss, which could threaten that stable $1 NAV.
Breaking the buck, as they say.
Exactly. And that's what everyone wants to avoid.
And are there things that make this mismatch risk even worse?
Yes, the review highlights several amplifiers. One big one is having a lot of large institutional investors. They're sophisticated, they watch closely, and they can pull huge sums very, very quickly if they sense trouble.
Faster than lots of small retail investors might.
Much faster, and a much larger size. Another amplifier is that stable NAV structure itself. If you think the $1 price is at risk, there's a massive incentive to be the first one out the door to get your full dollar back before anyone else possibly gets less.
The first mover advantage.
Precisely. And that ties into the third factor, rules that create threshold effects.
What does that mean?
Well, imagine a rule that says if a fund's level of instantly available cash drops below, say, 10%, then it must impose fees on withdrawals, or even temporarily halt withdrawals, impose a gate.
Okay.
If investors know that rule exists, they might start pulling their money out before the fund even hits that 10% threshold, just to avoid potentially getting hit with the fee or the gate. So the rule itself can actually trigger the run it's trying to manage.
Wow, yeah, that's a perverse incentive. It's interesting, though, the review mentions some countries didn't really see this liquidity mismatch as their main worry.
That's right. Some authorities felt that for their MMFs, the rules were already strict enough. Maybe their funds can only hold extremely liquid government debt, for example, making the asset side of the mismatch much less of a concern.
Makes sense. And what about money flowing across borders? That must complicate things.
Hugely. There are significant cross-border flows, especially in Europe. You might have a fund in Ireland holding German corporate debt with investors from France.
Right.
This interconnectedness means problems in one place can spread easily. And sometimes, data gaps make it hard to even track who ultimately owns the assets or who the investors are, which makes assessing those spillover risks tricky.
Does it also create chances for, shopping around for the easiest rules? Regulatory arbitrage.
That's definitely a concern. If one country tightens rules significantly and another doesn't, activity might just shift to the jurisdiction with lighter regulation, potentially weakening the overall effort. It's an ongoing challenge.
So vulnerabilities identified in major hubs like the US, EU, UK, China. But some places felt their systems were okay.
Yeah, places like India, Indonesia, Saudi Arabia reported that while they monitor things, the size of their MMF sector, the types of assets held, and their existing rules meant they didn't currently see MMFs posing major financial stability risks for them.
Okay. And this isn't just theory, we've seen these risks play out.
Sadly, yes. The big one everyone remembers is March 2020, the dash for cash when the pandemic hit.
Right, markets went haywire.
Exactly. Massive sudden demand for cash everywhere. MMFs, particularly in the US, UK, and parts of the EU, faced huge redemption pressures. They had to sell assets into markets that were already seizing up. It required massive intervention from central banks to stop a wider meltdown.
A real near miss, it felt like. Was that the only recent scare?
No, more recently, remember the UK's LDI crisis in September 2022? Liability-driven investment strategies used by pension funds blew up.
Yeah, that caused chaos in the bond market.
It did. And those pension funds needed cash fast for collateral calls. Where did they get it? They pulled billions from MMFs, especially sterling-denominated ones. The outflows from some funds were incredibly sharp.
How sharp?
For some specific funds, the daily redemption rates were actually worse than what they saw in March 2020.
Wow. Bigger than the pandemic shock for some. That says a lot.
Wow.
Any other examples?
The review mentions others too. Korea saw some MMF pressure linked to interest rate hikes. Canada had issues back in 2020 tied to corporate credit rating downgrades, needing some regulatory relief. South Africa had historical instances linked to bank failures where MMFs held deposits. Argentina saw big outflows after a public debt restructuring in 2019, though their funds apparently managed to meet redemptions. Each case, big or small, just reinforces the underlying fragility.
Okay, so those lessons have clearly spurred action. What are the main ways authorities are now trying to fix these vulnerabilities? The review outlines 4 main approaches.
That's right. 4 main policy toolkits are being deployed, building on those earlier international recommendations from 2021.
Let's take the first one.
Okay, the first is about imposing costs on redemptions. The idea is simple. Make the people pulling money out during stress bear more of the cost of that withdrawal.
How does that help?
It reduces that first mover advantage. If you know it might cost you extra to redeem when everyone else is redeeming, you might be less likely to run preemptively. It makes remaining investors better off, relatively speaking.
What tools do they use for that? Like fees?
Exactly. Tools like swing pricing, where the fund share price is adjusted slightly downwards during heavy outflows to reflect the cost of selling assets quickly. Or anti-dilution levies or liquidity fees, basically direct charges on redemptions under certain stressful conditions.
Were these things invented just for this?
No, interestingly, these kinds of tools, especially swing pricing, were already available in many places, often at the fund manager's discretion. But the review notes they were hardly ever actually used for MMFs before this push.
So the change is making them more common or mandatory?
Pretty much.
Hmm.
The U.S., for example, has brought in a mandatory liquidity fee framework for institutional prime and tax-exempt MMFs. It kicks in if daily net redemptions go over 5% of the fund's assets. They also significantly hiked liquidity requirements alongside this.
And elsewhere.
In the EU and the UK, the direction seems to be towards requiring MMFs to have at least one of these types of tools available in their toolkit,
Right.
ready to deploy if needed. So formalizing the ability to impose costs.
Okay, making withdrawals potentially costly, that's tool one. What's the second approach?
Second is focused on absorbing losses. This
Yeah.
is about making the fund itself better able to handle potential credit losses on the assets it holds without needing a bailout or breaking that stable NAV.
Building a buffer inside the fund.
Essentially, yes. Ideas discussed include things like a minimum balance at risk, or MBR, where maybe a tiny slice of your investment isn't immediately redeemable, or, more directly, requiring the fund to hold its own capital buffer, like a bank does, to absorb losses.
Sounds sensible. How popular is this approach?
This is actually the least widely adopted set of tools. The review found that really only China had a capital buffer requirement before 2021, and they've since expanded it for their larger MMFs.
Nobody else. Why not? Seems like a direct way to handle losses.
Well, various reasons are cited. Some jurisdictions prefer pushing MS towards variable NAVs, arguing the fluctuating price already absorbs gains and losses. Others worry about the practicalities. How do you design it fairly? What are the costs passed on to investors?
Hmm?
And there's a view that even with a buffer, it might not be enough to stop a really fast, large-scale run driven by liquidity fears rather than credit fears. The U.S., for instance, looked closely at a capital buffer but ultimately decided against it, citing those design challenges, costs, and doubts about its effectiveness against rapid redemptions.
Right, so maybe not the silver bullet for runs. Okay, what's policy approach number three?
Number 3 is reducing threshold effects. This goes back to those rules we talked about, where hitting a certain level triggers bad consequences.
tripwires.
Exactly. The goal here is to get rid of, or at least soften, the link between, say, a fund's liquidity level dropping below a specific percentage and the mandatory imposition of fees or gates. Because, as we said, that link can actually cause the run.
So cut the wire.
Pretty much. Before 2021, the US, EU, and UK had these explicit links. Many other places either didn't have them or didn't allow stable NFVs anyway, so it was less of an issue.
And what's changed since then?
The US made big changes in 2023. They completely removed the ability for certain MMFs to use gates, and crucially, they removed the link between liquidity levels and mandatory fees. Fees can still happen, like the mandatory one linked to high redemption volumes, but it's not automatically triggered just by crossing a liquidity threshold anymore.
Okay, decoupling the trigger.
Yes. And the UK has proposed similar changes to remove that automatic link between liquidity levels and using these management tools.
But you said earlier that stable NAVs themselves are still around. No one's banned those.
Correct. That's a really key finding. Despite stable NAVs being central to some of these dynamics, no jurisdiction reviewed has actually eliminated them.
Why not if they cause some of these issues?
The feedback reported suggests major concerns. Investors, particularly corporate treasurers, really rely on that stable value for their day-to-day cash management. There's a fear that forcing everything to a variable NAV could just shrink the whole MMF sector dramatically.
Which would hurt funding markets.
Potentially, yes, since MMFs are such big buyers of short-term debt. Plus, there are practical hurdles, operational changes, tax implications that would need sorting out if you moved away from stable NAVs entirely. It's a really difficult trade-off for regulators.
Yeah, you fix one problem but maybe create another. Okay, the fourth and final policy approach.
The fourth one is maybe the most direct. Reducing liquidity transformation. This is all about tackling that core mismatch head-on.
How?
By making the MMF hold assets that are much closer in liquidity to the instant redemption they promise. So, requiring them to hold a higher percentage of assets that can be converted to cash within one day or within 1 week. It also involves limits on riskier or less liquid assets they can hold overall.
So forcing them to hold more truly cash-like stuff.
Basically, yes. And this isn't new. Almost all jurisdictions had some minimum liquidity requirements before 2021.
So the change is just cranking up those minimums.
Exactly. Since 2021, China, India, Japan, Korea, Switzerland, the US, they've all introduced new, or more often, higher minimum requirements for daily liquid assets, DLA, and weekly liquid assets, WLA. The UK is proposing higher levels too.
Can you give an example of how much higher?
Sure. In the US, for government and prime MMFs, the minimum DLA went from 10% up to 25%, and the minimum WLA went from 30% up to 50%. That's a pretty significant jump.
Half the fund needs to be sellable within a week.
Right. Europe and the UK have varying levels depending on the MMF type. India introduced specific buffers linked to outflow risks. but the levels aren't harmonized globally.
Oh, how much do they vary?
Quite a bit, according to the review. Daily minimums range from maybe 5% up to that 25% in the U.S. Weekly minimums range from 15% up to 50%. So different countries are setting different benchmarks.
Which must make calibrating it tricky, right? Especially with those cross-border flows.
Definitely. Finding the sweet spot high enough for safety, but not so high it kills the fund's yield or disrupts markets is tough. And doing that consistently across borders is even harder.
Okay, those are the big four approaches. Any other smaller measures worth mentioning?
Yeah, a couple of complementary things. India set up a specific backstop facility, kind of a lender of last resort, but for corporate debt held by mutual funds, including MMFs.
Interesting.
And places like the UK, US, Saudi Arabia, the EU are putting more emphasis on stress testing, simulating bad scenarios, and increasing transparency so regulators and the market have a better view of the risks.
And that challenge of cross-border consistency and avoiding regulatory arbitrage, is that still hanging out there?
Oh yeah, it's a recurring theme, different rules, different levels. It creates potential weak spots or incentives to move activity. The review notes the UK is really pushing for international coordination. The EU also mentioned they tried to harmonize rules on these liquidity tools across different fund types, partly to address this risk within the union.
Right. So let's try and synthesize this. What's the overall picture? Are MMFs fixed?
Fixed is probably too strong a word. The picture is more like sickened. Significant repairs are underway, but the blueprints aren't identical everywhere. Jurisdictions are taking concrete steps using different combinations of these tools, costlier redemptions, loss absorption, though less common, fewer tripwires, more liquid assets.
All aimed at making MMFs less likely to stumble in the next crisis.
Exactly. The goal is to avoid needing those huge central bank interventions like we saw in 2020. Build in the resilience up front.
So, progress, but patchy globally.
That sums it up well. Uneven progress, different paths chosen.
Which leaves us with a final thought, doesn't it? Something for you, the listener, to consider. Given how interconnected global finance is, and given that countries are taking these different approaches, different levels of action, how confident can we really be that this patchwork of reforms will be enough to stop the next MMF stress event from causing wider financial instability? What more might need to happen, especially internationally, to make sure resilience in one place isn't just undermined by gaps somewhere else?